Hi, Misty Stewart here, your local Midland Realtor, and I have the pleasure of having Cole on the phone with us today. I really wanted to stop and take a minute and just touch base and talk to you about how easy it really is to get into a home loan. I think people are scared. When they think about home loans, they think their credit's way out of whack. They don't think they have money. I'm here to tell you, you don't have to have $30,000 and $40,000 in the bank. And so I wanted to bring Cole on today so he could talk to us about the 3 C's, which I enjoyed hearing about. So Cole, if you could tell us a little bit about yourself and then we'll get on into it.
Yeah, hey, good morning. Cole Edwards here with Benchmark Mortgage. I've been a loan officer with Benchmark going on 5 years now, work in the Midland and also the Dallas-Fort Worth markets. Specialize in first-time home buyers. I work with a lot of people who use down payment assistance and also work with a lot of people that do new construction homes. So planning far out, whether it's 30 days or 3 months, I'm here to help anybody that I can. And kind of like Misty just touched on, basically what we use to get mortgage approval is what she said, the 3 C's. Those 3 C's are credit, collateral, and capacity. And I'll kind of touch on each one of those. Credit being the first one. So we usually like to see a minimum of 580 credit score. And there's a range for our loan programs between 580 and 680. You're going to fall into an FHA loan program, and anything 680 and up, we're going to put you into a conventional loan program. So that kind of covers the credit there.
For a first-time home buyer, just so they would know, because I know sometimes it took me forever as a young person to realize what's the difference, would you say, between FHA and conventional?
Absolutely. So an FHA loan, basically what it stands for is the Federal Housing Administration, meaning all of those loans are going to be insured and guaranteed by the US government. It gives people that maybe are a little younger or don't have an established a long job history or a long income history, the ability to be a home ownership and get out of paying rent. Whereas that conventional loan program is going to be insured by private investors. So all of those loans, whenever they close, they're sold to the secondary market. So it's not the government that is insuring those loans, but other financial private investors. So it's kind of a divide, but like I said, it gives young people the opportunity. It gives maybe people that are just coming to USA as a country for employment or whatever it might be. It gives them the opportunity to get into a home and not have to pay an arm and a leg for rent.
Very well. Okay, sweet. That gives a really good, clear definition. So when you talk about credit at 580, is there a way for, if I was brand new and I had no idea what my credit score is, instead of going to a website and filling out application, is there a way that I could find out my credit score just to see where it's at before I come to see you, so I'm not embarrassed or maybe surprised that I'm doing really good?
Absolutely, yes. So there's 2 options there. Everybody that has a social security number can get a free copy of their credit report once a year. It's very simple, www.annualcreditreport.gov, I think it is. You go there, you give your legal name, your date of birth, and your social security number. You get a full credit report with all 3 main bureaus, Equifax, Experian, and TransUnion. And it also shows you any open and closed credit lines you have. So that's a great thing to do. You can kind of start there, and it can, like you said, it can show you, okay, I have some work to do, or it can tell you, okay, it looks like I'm ready to take the next step in home ownership.
Perfect. Thank you. Yeah, very good.
Yeah, absolutely.
So once we get their credit established and we're good to go there, and so they have that 580 or 600 that you need, and you go into that collateral, what does that mean? What are you looking for in that?
So basically, collateral is the word that we use for people having the reserves or the savings for a down payment. We spoke about that FHA loan. With that FHA loan, the minimum down payment that you can put down is 3.5%. So let's say we're working off a $250,000 sales price. That's usually a pretty good range for first-time buyers or even people that are just, like we already spoke about, trying to get out of the rental market and into home ownership. 3.5% of 250K is $8,750. So as a lender, we will want to see bank statements showing that they have that at least saved not only so that we can pre-approve them, but so when the time comes around that they're signing those closing papers, about to get the keys to their new home, we know that that check that they're going to hand over at the title company, the funds are there, nothing crazy is going to happen. They're going to cover what they need for those closing costs. They're going to get the keys, and then they're going to own the home.
Perfect.
Yeah.
Perfect. And then what about the closing costs? How would you figure that? So like I mean, I get it. You understand the 3.5%. That's pretty easy for anybody to do on the calculator. But how would
Yeah.
they in their mind figure out what to average or estimate for closing cost?
So at any point after you put in a loan application with any mortgage company at all, one of the first things that you should do is ask for a written loan estimate.
Okay.
There's going to be certain things that you can shop for and certain things that you cannot shop for. Things like that are going to be an appraisal, getting an appraisal done on the house. If there's not an existing survey, there will have to be a survey completed for the house. There's costs for administrative fees that the lender charges. There's costs for the credit report that we pull for the borrower. Certain things of that nature that whenever you request that loan estimate, any loan officer should be able to give it to you, and it can be very black and white as to what those charges are, what you can shop for and what you cannot shop for.
Okay, perfect. So I'm thinking if you said 8,000 and then the closing costs, in my mind, I'm like, okay, $4,000 or $5,000. Because I know all that stuff can add up. So that's a pretty little hefty chunk of change. So if someone's watching this and they're going, oh my God, I don't have $12,000 to $13,000 sitting in the bank, but they're a first-time home buyer, what are some of the things you can help them with?
Absolutely. So there is numerous loan programs that we can use for people that maybe don't have the money saved, or maybe they have the money coming in a future. Maybe they've got a bonus coming from work, or maybe they have a tax return coming as it is that season. There's numerous programs to where if you have the credit and the income for the qualification for it, basically what can happen is those lenders can roll those closing costs into the loan. So if you have a $250,000 sales price, maybe, and you're putting that 3% down, we'll call it a, $247,000 loan amount. We have the option to where we can up that loan amount by rolling those closing costs into the loan, to where maybe your loan amount goes up to, 248, 249. You're only having to come out of pocket that 3.5% down that we talked about. And then maybe your monthly payment does go up a bit, but you're not completely emptying out your bank account on day one.
Perfect. Okay, good. And there's also other programs too, that like down payment assistance. Is there such a thing as that?
Absolutely. Yeah. Very similar to what I just spoke on. There is credit and income requirements that come with those, but as long as you qualify there, it's basically the same thing. Some of those closing costs, and even there is times for some people to where that down payment can be rolled into the loan.
Okay, so regardless, it always gets rolled. I guess in my mind, I thought maybe it was forgiven. So it's not forgiven, it's just rolled into the loan.
Exactly. Rolled into the loan and then spread out over that 30-year term. If you're doing a 30-year term, a 15-year term, whatever those lenders offer for the borrowers, that amount can be rolled in and then spread across that 30 years, so that it never feels like a big amount of money coming out of your pocket all at once. It's kind of spread out and worked into that monthly mortgage payment that they should be able to afford.
Okay. Perfect. That's awesome. So then after that, you talked about capacity was your third C. I guess that's where you discussed the debt to income ratio.
Debt to income ratio. So that's going to be a big thing that we use. Like I said, not only for pre-approval, but for final loan approval as well. And I'll try to make it as simple as possible. Basically, what we do is we take all of your recurring monthly liabilities, all of your monthly debts, basically, which could be an auto loan, it could be credit card payments. For some people, it could be back taxes or child support payments that are owed, any of the stuff that's going to show up on a credit report. So if it's something basically that you can pick up the phone and have canceled within one phone call, such as, a cell phone bill or a subscription to Netflix or something like that, We're not going to use those. We're going to mainly use the things that we're going to see on that credit report. So the big ones, like I said, auto, credit cards, stuff like that. We're going to take the total of those amounts monthly, and we're going to divide it by your gross monthly income. So your income before any taxes, any insurance comes out, we're going to divide that, and it's going to give us a percentage, and we will use that percentage also for approval.
Okay. So what's the minimum?
So whenever we do an FHA loan, we'll speak on FHA loans, that percentage that we like to keep it under is usually up to about 57, 58%. Whereas conventional loans, as we spoke about, kind of your cheaper, maybe better option loan program, if you can fit in there, we usually like to keep those ratios below 43%.
Okay, perfect, perfect. So then when you put all this together, at the end of the day, you're just trying to verify that they're able to make that monthly payment without strapping them too much.
Exactly. Yeah. Showing that they have the capacity to repay that loan.
Gotcha. So question then is, if you had that $250,000 loan that we were talking about, and they, did their down payment, say they didn't really need, that they didn't need the down payment assistance, we're not going to roll anything back in.
Yeah.
What would you say with the current rate, which I'm not even sure what the current rate is? What is the current rate? It keeps going up. I can't keep up.
Is most definitely going up for people that are in good standing credit right now. The par rate that I'm kind of putting out there is 4.25.
Okay.
They'll say yesterday, Jerome Powell, the federal chairman, came out and said that there is going to be a rate hike this month. And then we should probably expect another rate hike in May, kind of as the economy is rebuilding itself and a few things are getting back on track. So it makes people nervous to hear that rates are.
So it's like, buy now, buy now,
buy now. Yeah. But then you also have to have the perspective to remember maybe a decade or 2 decades ago, we were looking at interest rates well over 10%. So we're flirting in between the area of 4 and 5% says that borrowing money right now is still very affordable.
Okay, good. So what would the monthly payment then be at that rate that you gave us at that 4.5%, like on the lower scale of their, say their credit score was like a 580 or 600. They're going to do that 250. They're going to do all their down payment. What do you think on average their monthly payment would be?
Sure. So a monthly payment is going to be made up of a few things. You're going to have principal and interest, which is your main part, basically what you're paying to borrow the money. And then you'll have your taxes, insurance, which will property taxes, which is going to vary between property to property. You'll have mortgage insurance, then you'll have hazard insurance. So if we're using that $250K with the minimum down payment of 3.5%, I would estimate probably a monthly payment somewhere between $1,300 and $1,400.
Wow. That's phenomenal, because I don't know if you are aware, but a 1-bedroom apartment here in Midland, Texas is $1,300 a month if you want to be in a new, nice one. So if you think about a house, generally a house, a $250,000 house is a 3-bedroom, usually going to be a 3-2. And so you're getting so much more money, so much more house for that amount versus an apartment. Wow, that's eye-opening. I don't think I expected you to say that. So I was like, whoa, that's really promising for people who are struggling to pay. And if they have children, they're paying $1,700 to $1,800 a month for a 3-bedroom apartment. So if you can save money on a house, that's a really awesome thing.
Absolutely. Yeah. And it probably sounded somewhat complex as we went through it. But if you can look at it as simple as those 3 C's and just putting a check by each of those C's, you can find yourself as a homeowner, which is not only financially huge benefits, but like you said, if you have children or, if you're wanting to move to a better part of town or whatever it might be, the benefits are endless going from that rental market into home ownership.
Right. So if I was a new home buyer and I listened to what you had to say and I took the 3 C's, I would think that my next steps, if I thought, man, I want to buy a house in the year, that's my goal, is to buy a house within the next year. I would think my first steps would be, 1, to order my credit report, correct? Take a look at that, make sure that my score is where it needs to be, take care of some bad debt, and then start taking care of getting some debt paid off, and then start saving some money, because that would get all of our 3 C's taken care of.
Simple as that. Yes, ma'am.
Know our credit, save some money, fix our credit. Yeah.
Bingo. Yep. Get those scores, establish a budget so that you can save money, pay off any bad debt so that debt to income ratio is in a good place. Yep. Simple as that.
It sounds super simple, doesn't it?
Yeah, yeah.
If we all just had a little bit of extra money coming in, it would be a little simple, because I know those that are living in apartment complexes that we talked about earlier, it's harder for them to save money when they're spending so much on that apartment, but I guess where there's a will, there's a way.
Yeah.
People will figure it out.
Absolutely, I'd say so. And you know, kind of like you just spoke on, use the advantages that you can. Like I said, it's tax return season, so a lot of people have money coming in there. You know, some of these apartment complexes offer certain things for people trying to maybe get out of leases and go into home ownership. There's certain benefits that you can use there. So do your research, you know, reach out to the professionals. If you're needing to talk to a real estate agent, obviously reach out to Misty. If you want to talk to a mortgage lender, it's never too early to do so. You don't have to be ready to get that pre-approval letter to reach out to a mortgage lender. In my mind, it's better for us to hear from people earlier in the process so that we can establish a long-term plan, so that when the time comes, there's absolutely no hiccups, there's absolutely no roadblocks, and it's smooth sailing right to that closing table so that they can get the keys to their new home.
That's awesome. That's good. So you're like a partner in getting their credit, getting them to that closing table.
Absolutely. Yep. Partner all the way up to that closing table, and then a partner for life after that. If there's ever any questions, or, you know, you stack the benefits of being a homeowner and you want to upgrade, you want to move to that new house, you know, maybe you get to the point where you want to own investment properties and start getting some mailbox money, you know, you get yourself a good mortgage lender and a good real estate agent on a team, and they'll be your team for life.
That's awesome. Awesome. Well, I'll make sure, Cole, get your information up on the screen for everybody to have for contact. So you do Midland and the DFW area, correct? Well, the Permian Basin and the DFW area.
Yep, that's correct. So I'm licensed to do business anywhere in Texas and specialize in the DFW market and the Permian Basin market.
Perfect. Awesome. Well, I thank you so much for your time today. I really enjoy you sharing, and I hope that people reach out to you as well as to me and make their home dreams a reality.
Absolutely. Thanks for having me.
Thank you.